Hi everyone, we're now going to look at two of the practice problems in chapter 6, problem 6.5 and problem 6.10. That's where the 10 came from. So in problem 6.5, we're going to look at some of the concepts you learned as far as how revenue is now recognized. Revenue has always followed the principle of the revenue recognition principle, record revenue when earned. A few years ago, the FASB came out and said, we've got to be a little bit more specific about that. We need to give better guidance than when revenue's earned. And that's where this chapter comes from. So let's take a look. January 1, Revis Consulting entered into a contract to complete a cost reduction program for Green Financial over a 6-month period. Revis will receive $20,000 from Green at the end of each month. If total cost savings reach a specific target, Revis will receive an additional $10,000 from Green at the end of the contract. But if total cost savings fall short, Revis will refund $10,000 to Green. Revis estimates an 80% chance that cost savings will reach the target and calculates the contract price based on the expected value of the future payments to be received. Prepare the following journal entries for Revis. What is the journal entry on January 31st to record the collection of cash and recognition of the first month's revenue? So let's take a look here. So this contract is going to require 6 payments of $20,000 plus or minus $10,000 at the end of the contract. So the contract will provide either $130,000 or $110,000. So Revis would estimate the expected value of the transaction price as 80% of $130,000. 104 is the expected consideration. The 20% chance of $110,000, which would be $22,000. So the expected value of the contract price at inception is $126,000. So each month, Revis will recognize $21,000 of revenue, $126,000, the expected value, divided by 6 payments. They will debit cash for $20,000, credit service revenue for $21,000, and debit bonus receivable. Remember, there's a chance that they're going to receive money back at the end, so they're going to store this month's portion, $1,000, in bonus receivable. Assuming total cost savings exceed target, prepare the journal entry on June 30th to record receipt of the bonus. Well, each month they debited bonus receivable $1,000. So by the end of month 6, there's $6,000 in bonus receivable. So they'll credit the bonus receivable for $6,000, debit cash for $10,000 because they received $10,000. The other $4,000 will now be recorded as service revenue. What if instead the cost savings fall short of target and Revis actually has to pay the $10,000? They'll credit bonus receivable, credit cash because they got to pay $10,000, and debit service revenue for the total. The $6,000 in revenue they showed as if they were going to receive that back, it's not happening that way. So now they have to debit service revenue for the part of bonus receivable that was recorded as revenue that shouldn't have been, and then the $10,000 in cash they ultimately had to pay. So just taking a look at one of those various types of performance obligations presented in the chapter. And your exercises will help you cover the other ones. Now we're going to go to problem 6-10, which is a major part of this chapter. It's on long-term contracts. So let's take a look at that. And there's our answer key. So first of all, when you are a company that is providing a project or a service that lasts for more than a year, so your revenue is being earned over more than a year, you have a long-term contract. This company, Westgate, began a contract to construct a road for Santa Clara County for $10 million. So that $10 million to Westgate Construction is the overall revenue on that project. The road was completed 2 years later. It took them 2 years to complete this contract. So how do they record revenue related to this contract? And how do they determine that amount? Well, the first thing we're going to do is show you how to calculate the amount of revenue to be recognized each year and the gross profit. We use what's called the percentage of completion method when a contract lasts for more than a year. The contract price of this contract was $10 million. So that's the total revenue that will be recognized over 3 years. How do we determine the dollar amount that we show this year? We take the we first need to determine the total costs that have been incurred to date. They give that, 2.4 million. How much in additional cost do we expect to have? Another 5.6. So this project is going to cost a total of $8 million. So as of the end of year 1, the company expects a gross profit overall on this project of $2 million, a $10 million contract minus the total cost to complete. How about in 2022? Well, in 2022, we find out the total actual cost as of the end of 2022 will be the 2.4 they spent last year, plus an additional 3.6 they spent this year. So by the end of 2022, the company spends $6 million. They expect to spend another $2 million next year. So they still are only, at the end of year 2, they're still expecting only to pay a total of $8 million to make revenue of 10. So their gross profit, $2 million. 2023. The actual costs incurred in that year were 2.2. So they actually spent a total of $8.2 million. 2.4 the first year, 3.6 the second year, and 2.2 the third year. There are no more costs because the project's done. So of the $10 million in revenue, that's locked in stone, that's the contract. They spent $8.2 million to construct the road. So their gross profit on this project is 1.8. So that's showing us how we determine the gross profit on the project each year. We have to look at actual costs through the end of that year to the revenue. Now, how much revenue should be recorded of that $10 million each year? Well, we base that calculation on how much of the project is actually complete. We determine how much of the project is actually complete by the actual costs paid through the end of that year, actual costs through the end of that year divided by total expected costs. So the first year, our actual costs through the end of 2021 are 2.4 million. Divide that by the total costs expected of 8 million. So 30% of the project is considered to be complete. So because we've spent 30% of all the costs we expect to spend. So that means $3 million of the 10 million should be recognized as revenue in 2021. Now look at 2022. We don't take the costs just for 2022 in our numerator. What are we determining here? How much of the project is complete by the end of the second year? Not how much was completed in the second year, but how much of the entire project is completed by the end of the second year. 6 million is how much we have spent in actual costs of the expected total of 8 million. So 75% of the project is completed. So by the end of 2022, we should recognize 7.5 million, or 75% of the $10 million as revenue. We've already recognized 3 million of it last year. So this year's revenue to be recognized, 4.5 million, the difference. Finally, when the project is 100% complete, we should recognize by now all $10 million. So far, we have recognized 7.5 million of it, 3 million from 2021 and 4.5 from 2022. So the remaining revenue of 2.5 million will be recognized in 2023, the year the project is complete. So that's how we determine the dollar amounts of revenue that should be recognized. Now, how much gross profit will be recognized? Well, if we're recognizing 3 million of the revenue in 2021 and the actual costs in 2021 are 2.4 million, then the gross profit that will be recognized is $600,000. In year 2, the actual revenue that will be recognized is 4.5 million. They tell us the actual costs during just 2022 are 3.6. That's in your problem. So how much in gross profit will be recognized? 900,000. Finally, in year 3, 2.5 million is the amount of revenue that will be recognized. We had actual costs in 2023 of 2.2 million. So 300,000 of the gross profit is recognized in that year. If you add up the 3 years, you will have recognized a total gross profit of 1.8 million. So remember, the amounts we determined up above in this table are not how much gross profit is recognized each year, but of the total revenue and total expected cost, what the total gross profit would be. And we update that each year as our actual costs actually change. Now, the next part. What's the journal entries? Prepare all necessary journal entries for each of the years. Credit cash, materials, etc. for construction costs. So now we must make journal entries for these items. We figured out dollar amounts, but what's the journal entries? You need to recognize the total actual costs that have been paid in an asset account called construction in progress. Inventory. It's an inventory account. So an asset, construction in progress, will be debited each year, and that cash, materials, etc. will be credited for the actual cost incurred for that year. So you can see the first year, it would be 2.4 million. The second year, 3.6, and then in 2023, the dollar amount in that journal entry would be 2.2. What else do we have to do? We have to recognize the amount of billings that have occurred each year. You have to remember something. The company, Westgate, doesn't build the entire project and then send a bill for $10 million. No, they're going to build this or charge the county money as they progress. So they sent the county a bill for $2 million in 2021. So they debit accounts receivable, and they credit an account called billings on construction contract, which is like a inventory account. That's how we'll call it. Billings on construction contract. Just going to, and the billings on construction contracts are always matched up with the construction in progress account, and you'll see that in a few minutes. So we don't credit revenue when we debit accounts receivable for billing. No, this is just sending out a bill. That doesn't mean that's how much revenue we earned. So instead, we credit, you could look at it as a contra account to the construction in progress, billings on construction contract. Construction in progress is an inventory account where we store the costs. It's like work in process. We store the costs of construction so far that we're still working on. Then when the county sends us money, we'll debit cash and credit accounts receivable. So in 2021, we billed the county $2 million. They sent us $1.8 million as cash, and that's presented. In year 2, they sent us $3.6 million of the $4 million we billed. And then in the remaining $4 million that was billed in 2023, they sent us the remaining cash they owed us of $4.6 million. So we debit a construction in progress for actual costs and credit, it could be cash you're paying, it could be materials you used, whatever. For any billings that are made, we debit accounts receivable and credit this contra, billings on construction contract. When we receive money from those billings, we debit cash and credit accounts receivable. Finally, we need to record the revenue that's being recognized, the actual costs, and the gross profit as a journal entry. So when we credit revenue from long-term contracts, we credit it for the dollar amount we determined up above, $3 million. We debit an expense account, cost of construction. You could think of that as cost of goods sold. So these two accounts, the one with the $3 million in revenue and the cost of construction of 2.4, they're the only two accounts that are going on our income statement. To make our journal entry balance, the $600,000 gross profit that will appear on the income statement is debited to that construction in progress account and added to the other costs incurred because we have nowhere else to put it. Gross profit will automatically come out on the income statement when we subtract cost of construction from the revenue. So we need to store that somewhere, and since there's nowhere else to put it, we put it in cost construction in progress. Do the same thing for the second year with the actual revenue we're recording, $4.5 million. Debit the expense account, cost of construction for the actual cost incurred, and debit construction in progress for the gross profit for that year. And then you have your final year's revenue, costs, and gross profit. So when you do that, it will ultimately show the gross profit properly on the income statement each year. So those are the journal entries. Now, before we go and finish this off, here's what I suggest you do. Create some T accounts. So I'm going to create a T account for construction in progress. I'm going to create a T account for accounts receivables. I'm going to create a T account for that contra account to construction in progress, billings on construction contracts. Okay, and I think that's good. So at the end of the first year, I'm going to debit construction in progress, $2.4 million, and we credit cash materials. Debit accounts receivable, $2 million. Credit the billings on construction contracts, $2 million. And then I'm going to credit accounts receivables, $1.8 million. The final journal entry will be a debit to the construction in progress, 6 million. So at the end of year one, my construction in progress account, 3 million debit balance. My accounts receivable has a 200,000 debit balance, and my billings on construction contracts are 2 million. So when I report this information on my balance sheet, I'm going to say, here's my accounts receivable, 200,000. That's its current balance. My construction in progress, that's really the total revenue we've recorded, isn't it? And that's what you have in that account. So of the 3 million in revenue, even though it doesn't say revenue there, remember what's in there, the cost plus the gross profit. So of the 3 million in revenue, we have billed for 2 million. So of the costs and profits shown so far, we've only asked for 2 million of it. So those are in excess of the billing, and that's shown as an asset on our balance sheet. You net those two accounts together and it's shown as an asset. So that happens at the end of year one. Let's see what happens at the end of year two. You saw it, but let's see it again. What happened? You're going to debit your construction, CIP, construction in progress 3.6, debit accounts receivable for 4 million, credit the billings on construction for 4 million, credit accounts receivable 3.6, and debit the construction in progress for 900,000. So now your construction in progress account has a debit balance of 7.5. Your billings on construction contracts has a $6 million credit balance, and your accounts receivable should be at 600,000. So when we report that on our balance sheet, there it is. Accounts receivable, 700. Your construction in progress is 7.5. But of that, you've only billed out 6 million. So it's basically saying how much we still have to bill, 1.5 million. It's really additional accounts receivables. We should have billed it, we just didn't yet. So that's an asset to us. Now, at the end of year three, take a look, what happens? Construction in progress is debited 2.2 million. Accounts receivables debited 4 million. And your billings on construction are credited for 4. Accounts receivables credited for 4.6. You have 0 left in there. You've billed all $10 million in accounts receivables and you've collected all of it. And then the final is a debit to the construction in progress for 300,000. So your construction in progress has a $10 million balance, accounts receivable 0, and billings on construction contract has a credit balance of $10 million. Let me see. No. So what do we do? At the end of year three, there's a journal entry they're not showing you. We debit billings on construction contract 10 million to close that out, so it's a 0 balance, and we credit the construction in progress account to close that out, and it has a 0 balance. So those accounts are always compared to one another during construction, but at the end, they're going to equal. And then we just reset them both to 0. The construction's done. The asset is now owned by the county. You've recognized all the gross profit on this project over the life of the project, and you've collected all the money. Excellent. We like that. So that's how we account for construction. Now, let's change it up a little bit in part 4. Calculate the amount of revenue and gross profit in each of the 3 years, assuming the following. So we're not going to do the journal entries and everything. We're just going to look at how our gross profit calculation changes. So now our costs incurred to date are 2.4. Estimated costs to complete are 5.6. So you add those two together, total costs are expected to be 8 million of the 10 million, so a $2 million overall gross profit. But now actual costs in 2022 are going to be 3.8. So how much have we spent by the end of 2022? 3.8 plus 2.4 or 6.2. And the company estimates an additional 3.1 of expenses are still going to be paid to equal 9.3 million. So now the overall gross profit on this project has changed. It went from 2 million, but because the costs increase from 8 million to 9.3 overall, the overall gross profit is only looked at to be about 700,000 now. And that could happen. In the final year, the actual costs in the final year are 3.2 million. So we'll add the 2.4 actual from the first year to the 3.8 actual cost from the second year to the 3.2 actual cost from the third year. So the actual cost of this project ended up being 9.4 million, even higher than we expected. So the actual overall gross profit is 600,000. And that's all you will recognize on this project by the end. But let's take a look, because in year one, we really don't know these other things happening in year two and year three. They're in the future. So as of year one, we think we're going to have a $2 million gross profit. We take our actual costs divided by what we expect our costs to be at the end of year one. So we still expect a 30%, we still calculate that 30% of our project is completed. So we will recognize $3 million of gross profit, or of revenue. 3 million of the 10 million total revenue will be recognized. In year two, now our total costs at the end of year two will be 6.2, and now we've revised our total expected costs to be 9.3. So we'll use these new revised numbers. Our percent of completion right now is calculated to be 66.667%. So multiply that by the 10 million. So by the end of year two, this company should recognize $666,667 of revenue. They've already recognized 3 million of it last year, so they'll recognize the difference this year. Finally, in the third year, they're going to say, how much revenue should we recognize? Well, all 10 million, because it's done, 100% complete. We've recognized part of that already in the first year and the second year. So the part that's still remaining must be recognized as revenue in that last year. So over those 3 years, the revenue, the 10 million, is being recognized. Now, how do we get the gross profit? Take the revenue you're recognizing each year and subtract your actual expenses. So 3 million in revenue in year one minus actual costs incurred, 2.4, gross profit is 600,000. In year two, you're going to recognize 3,666,667. Subtract your actual costs for year two, which remember are 3.8 million. So it's actually a negative gross profit. And then in the fourth year, you're going to recognize 3,333,3333 of revenue. Subtract the costs from that year, which were 3.2 million. So the gross profit will be a positive 133,333. Now net those 3 years gross profits together, and you only really recognize the ultimate actual gross profit of 600,000. So this is to show you in a year, you may have your gross profit become negative. Now, what's important is that may happen, and that's okay. What we're concerned about is if the whole project's, the entire project's gross profit is negative. It's not in this case because it's still at a positive 600,000 overall. But let's see what happens when that does. And part 5 will be showing us that. Part 5 now Our expenses start out the same, 2.4 million. We expect 5.6 in additional, so we still are expecting an $8 million total cost. Subtracted from our contract price, we get $2 million gross profit. So we're still profitable in this project. But maybe something changed. Maybe prices increased dramatically. Something big in the industry happened or in the world. In the second year, our actual cost incurred will be 3.8 million. So how much have we spent to date? 2.4 plus 3.8 or 6.2. And we still expect to spend another 4.1 in costs on the project. So now our actual costs are above, the total actual costs are above the revenue. So overall, we're going to have a negative profit on this. That's not good. Take a look at the third year. The actual costs come in at 3.9 in our third year. So we add the 2.4 to the 3.8 to the 3.9. So overall, the project cost us $10,100,000. We only got 10 million as revenue, so we didn't make any money on this. We had negative gross profit overall on this entire project of 100,000. Now, how do we recognize this? The first year, we're still going to only recognize $3 million as revenue. Now, in the second year, we're going to take the actual cost of 6.2 divided by the total expected cost of 10.3 to determine how much of the project is completed by the end of the second year. And you can see it's 60.2% basically. Multiply that by 10 million. That's how much revenue should be recognized by the end of year 2. We've already recognized 3 million of it last year. So now we're going to recognize an additional $3,019,417. In the third year, when it's 100% complete, we should have recognized all 10 million. We have recognized 6,019,417 between the first year and the second year. So the remaining 3,980,583 is recognized in revenue in the third year. What does this look like when it comes to gross profit? Well, in the first year, we recognized 3 million and our costs were 2.4, so 600,000. In the second year, as soon as we see we have our gross profit is a negative 300,000, okay, we must decrease last year's profit that we already recognized. So we're not even worried about how much in revenue and how much in expenses. We have to decrease the overall, the income statement in the year we feel there's going to be a loss on the entire project for that loss. So we wipe out any gross profit we've shown previous, and we take the additional gross profit loss we expect. So we don't wait till the end and let it all iron out. We go, oh, we're going to have a 300,000 overall loss on this project. Wipe out that $600,000 loss last year by showing it as a loss this year, and then add another 300,000 for the actual loss. So we actually will be showing a $900,000 gross loss in year 2. Now, since the loss isn't as great as we originally expected, in year 3, we could show 200,000 of gross profit. The key here is that when you add the 600, subtract the 900, and add the 200, it's going to equal the overall loss on this project of $100,000. So that's really important to know when you have losses. If it's just a loss in a year, like we saw up in part 4, overall the project was still profitable. Yeah, it's okay. Show the loss. Don't have to worry about doing anything extra. But in a year where your overall profit becomes a loss, now you have to abandon what you've been doing. Make sure you wipe out any prior gross profit by showing it as a loss this year. Add the additional loss. And then if you recover any of that loss, like we did from years 2 to year 3, you could show that as net income or gross income, gross profit, gross income or profit. Okay, so that was a great problem to first go through and see the calculations for percentage of completion, determining gross profit and revenue, and of course the journal entries, and how these accounts impact the way we present the information on the balance sheet, and then the variations from there. So that concludes our discussion of the practice problems. Please post any questions you may have to the discussion board.